Hey, welcome back to the Money Pros. On today's show, we're taking a look back at investment markets in 2013 and a look forward to what might be in store for investors this year, 2014. With me are Rob Auclair, Certified Financial Planner Practitioner with Randall Financial Group, and Matt Dalton, he's CEO and Managing Partner of Belhaven Investments and a bond specialist. Thank you both for being with me once again. Let's jump right into it. Matt, given the underperformance in bonds, we talked about that in your last segment, does that mean that investors should be saying, you know, bonds didn't do well, I'm going to reduce my bond holdings because they didn't give me the same satisfaction that my stock holdings did, and rotate into stocks? Or conversely, should they be looking to reload on bonds now that things might be cheaper? What's your take on that? What's the strategy investors should be looking at, do you think?
What we see smart money do, Oliver, is you're always allocating to different asset classes. You want to be diversified, and when you have a drop in one asset class, there's a reason to allocate more funds to that so that your overall picture is balanced the way that you set out to balance it. So as you've heard Warren Buffett say for many, many years, buy when people are selling.
So if you've seen your 80-20 stock to bond mix go to 90-10 because of stock outperformance and bond underperformance, now's not the time to then take it to 95-5. You want to get back to that 80-10. Right. So you should potentially be looking at buying bonds in this opportunity, right?
That's correct.
Rob, I want to ask you the exact same question, and I think I'm a little more fearful here of what individual investors might do. We just talked about some of the spectacular returns, small caps up 40%, other categories up in the 30s domestically. Is now the time? Maybe I've been out of the market since 2008 when I got my head handed to me. Do I take my retirement fund that's been riding in cash for the past 5 years and go all in since it's looking good now? What do you think?
Well, from my perspective, it's still a time frame thing. And so whether we're looking at what happened this past year or reverse, 2 or 3 years ago, if it's long term, we can't time this market. Nobody knows how high it's going to go. Nobody knows how low it's going to go. So the idea of, well, let me just wait, let me wait, is really going to get you nowhere. So I think the idea of putting your money to work, have a well-balanced portfolio that's going to be reflective of your risk in your time frame is still the most important thing. I mean, people kind of look at that as a boring answer, but I think it's the right answer of having a well-balanced portfolio that's accurate to your time frame. And getting that money in makes some sense.
So, investors, I think they're worried that, gee, it went up, so I might jump in with both feet, or conversely, it went up, so I missed my opportunity. What you're saying is it's not a timing decision. It's about your long-term financial planning strategy. If some of your money belongs in the market, it belongs in the market as much now as it did 5 years ago.
Correct.
Well, let's hope that people actually buy into it. Now, we have to give our typical investing disclaimer here as we look forward to, here we're sitting in January, we've got a whole 2014 ahead of us, that nobody has a crystal ball. We're not in the business of trying to predict what's going to happen in the markets. But what I'd like to ask you guys, and Matt, I'm going to start with you, is what do you think the potential drivers are for markets, bond markets in particular in 2014, whether it be political, economic, or otherwise?
The drivers in 2014 are going to be the economy. The Fed is looking for some inflation. Inflation is the Achilles heel to fixed income. There'll be a heavy focus on where is the economy, is it improving, can they continue to taper? That'll be the focus. And as we were reminded on Friday, we can have bad numbers and interest rates can drop. So we're clearly not out of the woods yet. The Fed would like to get the stimulus program shut off and see how we do.
Inflation, it's interesting you mentioned that. Inflation's been remarkably under control with this low interest rate environment. What would the Fed do if they started to see inflation creep back into the system?
After they throw their party, I think they'll let inflation run a little hot for a while. They want to make sure that this economy is back and that we're off to the races. And at some point down the road, they may start to tighten.
All right, so something definitely to take a look at. Now, Rob, I'm going to ask you the same question without whipping out your crystal ball here. What do you think are going to be the things that move the markets? We'll talk equity markets in particular in 2014. We don't know if it's going to be good. We don't know if it's going to be bad. But what do you think the news headlines are going to be potentially?
Well, unfortunately, I think it is media-driven rather than maybe even fundamental analysis. But a lot of
Certainly
the
in the
information,
short term, right?
Right.
Yeah.
A lot of the information that I think we'll get during the year, the indicators and the reports that come out, the way they trend and the timing of how they trend, I think is going to be really important. The debt ceiling, when they vote on that in February, is that going to be positive or negative news, and how are people going to, react to that? We talked about, the Fed. The Fed, there's some new leadership there too. How do they spin that? So I think there's a lot of things, economically and government-wise, but I think it's all the timing of where the market is at those points in times, and are we getting some continuity of still good news? I think that's what the investor will follow.
So we've got about a minute and a half left. We know that there's going to be volatility in the system, good or bad year. That's going to happen. Let me ask you, and Matt, I'm going to ask you as well, what can investors do to manage that short-term risk in their portfolios, if anything?
Well, from my perspective, I could give you a long-winded answer, but I really think people need to look at rebalancing like they do every year. Right now we're looking at, let's say someone had a 60-40 equities to bond split. Right now that could be 70 or 80 to 20. Rebalancing that and just getting back to where you should be is something that's so simple. Do it. Reduce your risk and still have that long-term vision of what you're trying to achieve.
Mechanical, you don't need any foresight, and just get back to that 60-40 if you're up to a 70-30 or something like that. Now, what are your thoughts?
Volatility, when you hear that word, you want to think negative. Invite the volatility. It can be a positive as much as it is a negative. So again, timing the markets is a tough thing to do. Nobody can get that right 100% of the time. Stay invested, add to it, rebalance whatever it is that you and your advisor are working on to meet your goals. Invite that volatility.
Embrace the volatility.
Embrace
I think
the
I might get
volatility.
bumper stickers for that, because Lord knows we've seen a lot of volatility over the past several years. All right, I'm going to hold it there. For more details on market performance in 2013 and what to do in 2014, visit our website at foxprovidence.com, where you can also view a replay of this segment. Up next, each of our guests will give us their single best investment tip for 2014. So stay with us. There's still more to come right here on The Money Pros.